What is the earnings credit rate, or ECR? It's a daily calculation of soft dollars that you provide to your business customers as an allowance. And there is usually a methodology. These days, I'm hearing that most institutions are not really using a methodology other than looking at the market and what other banks are doing. Now, the major thing you have to remember, the account analysis is not a service, it's not a product, it's your billing system, it's your invoicing for Treasury Management services. This here is a picture of a one-page summary account analysis statement. For every business checking account that is it's analyzed, that is in the core, in the system for account analysis, is going to produce one statement per account, and then the system will produce one summary account analysis statement that will group all of them. So let's go through this in detail. This is a sample account analysis statement where you have the name of the customer, the address, the account relationship information goes down, account number, and statement date. Typically, they will be on a calendar month. That's the analysis period, and that's the month in the year. So again, each business checking account will produce one analysis statement plus a summary statement for all of the business customers' checking accounts. So the next section is the balances and earnings. So in this example, you have the average ledger balance, less float, gives you the average collected balance. You have the earnings credit rate at 80 basis points, which is high actually. Right now, the average that I'm seeing nationwide, including the latest rate cut, because that influences your ECR, I'm seeing an average on the low side from 20 basis points all the way to 80 basis points up to a 1%. If you are above the 1%, you are an outlier already. You are higher than market. Having said that, you can customize, depending on your system, the ECR. So the ECR makes the calculation based on the investable balance. In our example, it's $560,000. So this next section gives you the entire summary of the activity. So you have two accounts, deposit tickets, deposited items, etc. At the bottom, you have the total analyzed costs, $439.89. And it tells you your system, if you have a modeling system, would be amazing, but a lot of you may just have a template to give this to your prospects. It gives you the required balances. So this customer would need to have $743,332.64 to actually offset their service charges. In this example, if you notice from before, the earnings credit allowance of $368 is all they had. So they have a shortfall of $71.66. That is the hard charge to your business customer operating account, and that actually should flow to your general ledger fee income. So the main thing I want you to remember from the account analysis is that your analyzed fees were $439. But your customer paid 368 of those with balances. That's where the core deposits take in. And then the $71 was what was hard charged to their checking account. Thank you to Ncontracts and Team Clarity for sponsoring this video. I hope to see you there.